Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about first today's US market review. A historic reversal rocks Wall Street. The Dow soars to a record high while a tech bloodbath sends the Nasdaq plunging. Is this the end of tech's reign and the start of a massive capital shift? Second, Fed civil war erupts. The latest rate cut triggers an unprecedented three-way descent, the deepest fracture in 30 years. With hawks, doves, and super doves in open conflict, is the world's most powerful central bank losing control? Finally, AI bloodbath. Broadcom's 74% sales surge triggers a shocking 11% stock crash, igniting a sector-wide panic. Why did blockbuster earnings spark a market massacre? And what is the hidden truth about profitability that has Wall Street terrified? Warning, the market's experiencing a seismic shift today, investors. The Fed's hawkish pause is shaking up the landscape, and it's time to act decisively. The Dow closed at a record high 48,704.01, up 1.34%, while the Nasdaq slipped 0.26%, a signal that tech's reign might be waning. Let's break it down. The Federal Reserve cut rates by 25 basis points, but their tone was anything but dovish. Fed Chair Powell signaled a pause, hinting that the era of easy money is ending. This shift caused a capital exodus from high-flying tech stocks into value plays. Historically, when the Fed pivots like this, it marks the beginning of a prolonged rotation away from growth to value. The money flow is clear. Investors are reallocating from AI-driven tech giants to economically sensitive sectors. The Nasdaq's underperformance is a red flag. Capital is exiting mega cap tech, and if you're not adjusting, you're at risk. Listen to me. It's time to pivot your portfolio. In the valuation layer, tech stocks are feeling the heat. Oracle's disastrous 14% drop set off alarms, with free cash flow turning negative due to massive AI spending. Broadcom also stumbled despite beating earnings due to margin compression fears. This isn't just a pullback, it's a structural realignment. High P, E multiples are under siege as markets demand profitability over promises. This is your wake-up call. Cut tech exposure immediately. Rotate into financials and cyclicals, which are poised to benefit as the Fed stabilizes rates. Sector-wise, the day belonged to value and small caps. Financials surged 1.8%, with JP Morgan up 2.37%, riding the wave of higher net interest margins. Materials and industrials followed suit, up 2.2% and 1.1% respectively, as investors bank on economic stability. Meanwhile, tech lagged, with the information technology sector down 4.29%. ETFs like XLF and XLI are your go-tos for capturing this momentum shift. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. Short-term, reduce mega cap tech by 15 to 25%. Target stocks like Meta and MSFT, trim them down, and redirect into financials like XLF and small caps via IWM. Medium term, overweight financials by 3 to 5% and small caps by 4 to 6%. These sectors are set for earnings expansion as rate cuts filter through. Hedge your bets. For advanced traders, consider put options on QQQ. For intermediates, think about rotating into defensive sectors like XLP. Basics. Raise cash to 12 to 15% for flexibility. Remember, Oracle's collapse and Broadcom's margin squeeze are just the beginning. Watch for upcoming earnings from mega caps. Any capex warnings could trigger further sell-offs. Keep an eye on the December jobs report. A strong showing could reinforce the Fed's hawkish stance. And don't miss Fed commentary this week. Powell's pause is the talk of the town, but listen for any hints of flexibility. Time's ticking. Let's dive deep into today's critical market dynamics and prepare for what's ahead. Stay sharp. Stay informed, and let's navigate this market together. A crack has just appeared at the very top of the Federal Reserve. Just as markets digested the latest interest rate cut, a top official, Chicago Fed President Austin Goolsbee, went public explaining why he voted against it. Now, this isn't just a minor disagreement. The level of public dissent is something we haven't seen in decades. In fact, it's the highest number of dissenting votes among Fed governors since 1993. The real problem here is predictability. When the Fed is this divided, it becomes much harder for businesses and investors to predict its next move, which can lead to more volatility. A while back, we flagged that the FOMC's annual rotation was creating a structural split today's vote count. Is that fracture going public? And as we warned, a loss of predictability tends to lift rate volatility and risk premia. His reasoning points to a stark warning for the economy. Goolsbee notes that inflation has been above the Fed's 2% target for a staggering 4.5 years. And even more concerning, he says the last 6 months have shown no progress. So the thing is, Goolsbee is highlighting that stubborn last mile of inflation. While some prices for things like gas or used cars can fall quickly, other sticky prices for services like rent or insurance aren't budging. As we discussed a while back, that sticky bucket is the core of Goolsbee's worry. In a direct interview, Goolsbee said he was uncomfortable front-loading too many rate cuts. He argued the Fed should have waited for more data before acting, believing the prudent course was to wait until early 2026 for further cuts. And he's not alone. While Goolsbee was one of 3 voting members to break ranks, the internal division goes deeper, with 6 of 19 participants opposing the cut. Here's where it gets interesting. The division isn't a simple split between hawks and doves. The 3 dissenting votes actually went in 2 different directions. While Goolsbee and another member voted against the cut, a third member, Fed Governor Stephen Miran, actually voted for a much larger 50 basis point cut. He's argued the economy is weaker than it looks. So you have a 3-way split, one group saying cut, another saying don't cut, and a third saying cut even more. This level of disagreement really undermines the Fed's ability to give clear guidance. This sets up a major clash of economic philosophies. When we place Fed Chair Jerome Powell's reasoning alongside the dissenters, the contradiction becomes clear. Powell justified the cut by expressing worry that the labour market is weaker than it appears, pointing to a massive downward revision of nearly 600,000 jobs. He's concerned that waiting too long could mean acting too late to prevent a downturn. Meanwhile, Goolsbee and fellow dissenter Jeffrey Schmid are signalling that the real danger is still stubbornly high inflation. Their argument is that the Fed's current interest rate isn't actually high enough to be applying the brakes, meaning a cut would be like hitting the accelerator again. And interestingly enough, this internal Fed debate has global ripple effects, including for China. When the Fed cuts rates while other central banks adjust their policies, it creates major swings in currency markets. A weaker US dollar, for instance, could make the Chinese yuan relatively stronger, hurting Chinese exports. That uncertainty can feed through to bond markets with knock-on effects for asset pricing everywhere. So, looking ahead, what should we be watching? The most important things are the upcoming inflation reports, especially that sticky services data. At the same time, keep a close eye on labour market data, paying attention to any future revisions, and watch whether this 3-way split inside the Fed persists, because if it does, every meeting becomes a live test of how much guidance the Fed can still credibly give. Speaking of high-stakes battles that put credibility on the line, let's turn our attention to the tech world, where a blockbuster report has sparked a full-blown panic. The most unexpected news in the finance world today has to be what happened with Broadcom. The company posted blockbuster earnings, sailed past Wall Street estimates, and saw its AI chip sales surge a staggering 74%. The result? The stock plummeted 11% in its worst day since January as investors ran for the exits. And this isn't just a one-off event for Broadcom. The real story is what it signals for the entire AI sector. Smart money is starting to look past the immediate hype and is pricing in future risks, because after all, the market is a forward-looking machine. The shockwave hit the entire AI infrastructure trade. Oracle, already down 10%, dropped another 4.5%, and even titans like Nvidia and AMD slid about 3 and 5% respectively. Behind the scenes, a different story is unfolding. Some of these companies are taking on massive debt just to compete. Take Oracle, for example. Its debt to EBITDA ratio has climbed to 4.3 compared to an industry median of just 1.1. That signals the massive cost of building AI data centers is creating a real divide between the haves and have-nots in this race. So what's going on? Analysts are calling it AI angst. For the first time, the market is looking past the insatiable demand for artificial intelligence and asking a tough question. How profitable is this gold rush really? Actually, investors are getting nervous about the AI capex cycle. That's the money cloud giants like Google, Amazon, and Microsoft spend on data centers and chips projected to hit a staggering $420 billion in 2025? The answer came directly from Broadcom's C-suite. The company's CFO warned that gross margins will be lower because of the high upfront costs. In other words, the price of winning the AI race is getting more expensive. But that's not the whole picture. The real turning point was when Broadcom CEO, Hock Tan, poured cold water on a highly touted multi-billion-dollar deal with OpenAI, telling investors, "We do not expect much in 2026. That comment blew the lid off a huge vulnerability in the AI hardware business, customer concentration risk. Now, get this, that massive $73 billion order backlog Broadcom has, it comes from just 5 customers. 5. This means the entire investment thesis for these chip makers hinges on the unwavering spending of a tiny handful of hyperscale companies. If just one of them changes its plans, it sends shockwaves through the entire market. This leaves Wall Street grappling with a massive paradox. The situation presents a fascinating duality. On one side, Broadcom has a confirmed $73 billion backlog of AI orders. On the other, the very companies building the future of AI are now signaling that the path forward is paved with higher costs and shrinking margins, sparking this sudden crisis of confidence. Underlying all of this is also the constant geopolitical risk, particularly US restrictions on semiconductor exports to China. Looking ahead, the key signposts will be the future capital expenditure guidance from the major cloud providers and, of course, the quarterly gross margin reports from chip makers like Broadcom and Nvidia. We should also watch utility and grid CapEx announcements and the gap between reported profits and free cash flow at the biggest spenders. These data points will tell us whether the AI profit squeeze is a temporary phase or a new long-term reality for the industry.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.